Take a deep breath and concentrate on your thoughts. They come and go like waves, reaching the skies and then touching the sands before receding. Much like the market, which fluctuates beyond any of our individual control. Repeat after me. Breathe in, bullish. Breathe out, bearish. That's perfect. This very exercise is the essence of investing. Or so you will learn soon. Hello and welcome to Finforall by Jupiter. My name is Dipansha Dhingra and today we'll be talking about index funds. Index funds are the ones that mimic a stock market like NSE Nifty or BSE Sensex. A market index measures the performance of a basket of securities like stocks or bonds. And an index fund helps investing in all the securities within that basket. These funds are especially helpful when you want to diversify your portfolio and invest in a variety of companies. For example, if your index fund mimics the NSE Nifty index, which has 50 stocks under it, your investment will be divided into all those 50 stocks in similar proportions. If a particular stock makes up 1% of the index, then your index fund manager will seek to mimic that same composition by making 1% of its portfolio consist of that stock. Index funds generally follow a passive style of investing. This means they aim to maximize the returns over the long run by not buying and selling securities very often. While other mutual funds tend to outperform their benchmarks, index funds stay close to their underlying index in terms of returns. This is both a pro and a con. A pro because you know what to expect, and a con because the returns are not massive. Because of their passive management and sort of predictable returns over long periods, index funds are very popular assets when planning for retirement. So those of you planning to retire by 40, make a note of this. Another advantage of index funds is a low expense ratio. Expense ratio is the percentage of your corpus that your fund manager charges to manage your portfolio. Since index funds don't require constant monitoring or research, its expense ratio is lower than other mutual funds. There are some things you need to consider before choosing an index fund. Number 1, risk. When looking for an index fund, find the one with the lowest tracking error. Tracking error is basically the annualized standard deviation of the returns of an index fund from the underlying index. Number 2, flexibility. Compared to actively managed mutual funds, index funds may have less flexibility to react to price declines in the securities in the index. Number 3, time. It is generally advised to invest in index funds when you are looking to stay invested for 7 years or more. Not a hard and fast rule, more of a suggestion. This is because over a short period of time, these funds will see a lot of fluctuations, much like their underlying indexes. But over a long duration, these fluctuations average out and you can get 10 to 12% returns. Number 4, taxation. As with almost every rupee you make, your dividends and gains are taxed with index funds. If your fund pays dividends, a dividend distribution tax or DDT of 10% is deducted at source. In terms of capital gains, the standard rules of 15% tax up to 1 year and 10% of tax after 1 year will apply. Most experts agree that index funds are very good long-term investments. They are low-cost options for obtaining a well-diversified portfolio. As always, don't forget that you and only you can fairly judge your financial standing and goals before you get into investing. Preachy uncles or educational YouTube channels like this can only help so much. Until next time, thank you for staying tuned. For more on finance and everything beyond, follow Finforall by Jupiter on YouTube, Instagram and LinkedIn. Don't forget to leave a like and share your views in the comments below.